Good morning all, and welcome to this week's webinar from Thomas Westcott. My name is Patrick Tidwell. I'm one of the general practice partners of the firm based at Exeter, and that's my corporate backdrop behind me, the Cathedral and the War Memorial, and also based at our Tiverton office. And I have the pleasure of being the host for this morning's webinar. Today we'll be examining not the C word, COVID, but the B word, Brexit. It's quite interesting, hasn't it? With all the coverage of COVID over the past 18 months, the issue of Brexit has largely passed under the radar, with the possible exception of the Northern Irish sort of land border question. However, for no longer, because today we'll be examining the effects the EU single, or leaving this EU single market, has had in terms of the VAT and customs rules for both importers and exporters. And our speakers will address practical issues for both of these areas, which are all the more important now that the transitional periods have come to an end. Now, to lead us through this maze, and obviously bearing in mind it's GCSE results day, I'm delighted to welcome two A-star candidates for you today. Definitely no grade inflation here. First, with the lovely picture of the Plymouth Hoe behind her, is my tax colleague Annette Stone. Now, Annette is a tax director with the firm, and as you can imagine, is based in our Plymouth office. And she'll be kicking us off addressing a couple of VAT issues that she's saying that she gets asked a lot of questions about. So that'll be good. But by far the larger chunk of today's webinar will concern our very special guest, David Miller. Now, David's company is called the Customs People, which is a leading VAT and customs duty consultancy company in the UK. They're based at Stockport, is it, David?
Yes, that's right. Yeah.
And David will focus on the customs side of things. He will recap on the changes to imports and exports for UK business, the practical difficulties that businesses have encountered, and the measures that need to be taken to deal with them. However, full disclosure means that I have to inform you that on review of his bio on his company's website, I found that he is a fan of West Ham and St Helens. And he should really know by now that there's only one team, Champions League and Super Cup, and that proper rugby has 15 players, not 30. So what's the plan for today? Well, we'll hear from our speakers. The webinar will last about an hour. There will be a lot of talking from David because we want to make use of his expert knowledge. If you'd like to submit a question, you can at the events@thomaswestcott.co.uk, or you can ask it in the chat, the Q&A button just down there. If you'd like to remain anonymous, please post anon before you do. And just bear in mind that we can only answer kind of fairly general questions, but obviously David and Annette are both very happy to field your questions after the webinar if they're more detailed. So without further ado, that's enough from me. I'll hand over to Annette for her element of this morning's webinar. So Annette, over to you.
Thank you, Patrick. Good morning, everybody. I'm sure I don't need to remind you, but the transition period for the UK leaving the EU ended on the 31st of December 2020. So businesses have had to make decisions, sometimes forced decisions on their supply chains. Why? Well, not only have there been changes to duties and taxes on imports and exports, but there's a lot of practical things to understand and to consider. So I am very delighted that our expert speaker, David Miller, is going to summarise these main points for us. But as Patrick said, there are a couple of practical decisions about which I've been asked frequently over the last few months by clients. So I wanted to kick off with those. And so I'm going to talk about postponed VAT accounting for import VAT, and the introduction of IOSS. So postponed VAT accounting can make the import process smoother. So previously, when goods were imported from a non-EU country, VAT was either due immediately or there was an opportunity to set up a duty deferment account. But generally, pre the 1st of January 2021, there were no duties or VAT applied on goods entering the UK from the EU. Well, all that has changed, and it did catch a lot of people out post-January. The former non-EU rules apply to goods imported from the EU. So postponed VAT accounting is available to ease the burden. This is from a cash flow point of view and from an administrative point of view. So VAT registered importers can account for VAT on goods for those used within their UK business, registered business, on their next VAT return, rather than making that payment at the UK border and being issued with the customs form C79. So it is a simplified method of postponing import VAT, and it applies to imports from goods from anywhere outside of the UK. So how is this postponed VAT accounting election made? Well, it is voluntary, and in order to use PVA, it's made on the customs declaration alongside the VAT registration number, or EORI. Now, PVA enables importers to account for and recover VAT on the same VAT return, so helps with cash flow, and from a mechanics point of view, it's similar to the reverse charge. So we're looking at box 1 and box 4 on the VAT return. So you enter the import VAT payable, and then on the same VAT return, you have the import VAT reclaimed. Now, the customs declaration system will generate an online monthly postponed import VAT statement. And it's very important to retain these statements because they are evidence that that VAT treatment has been followed. So that is an overview of postponed VAT accounting. And as I've said, I have been asked by many clients about how this operates. So just wanted to summarise that for you. But a more recent change is import one-stop shop. That's known as IOSS. And this is since the 1st of July. The EU have introduced the IOSS regime. So this is looking at suppliers who operate via online marketplaces or who supply direct to EU consumers to sell goods to buyers in the EU without the buyer paying VAT at the point of import. So a UK business selling goods, business to EU consumer, is now responsible for paying a supply VAT, but this is for consignments valued less than 150 euros. Rather than a nasty surprise for VAT charges at import, which is better for the EU customer, and for the admin consideration does involve some registration to consider. So if we bear in mind that there's no UK VAT on sales, because these are now zero rated exports when we're selling into the EU. But from the 1st of July, this supply VAT is now to be considered. Another part of the change is that low value consignment relief has been abolished. So previously, where goods had a commercial value of less than £15, so 22 euros, there was no VAT payable. but that has now gone. So online retailers need to be aware of and consider whether to register for IOSS, as this is the electronic portal that businesses can use to comply with distance sale of goods. So if it's been facilitated via an electronic interface, it's considered to be where the sale has made, and at that point, in principle, is liable for the VAT. So if we think about eBay, for example, and a colleague of mine showed me an eBay contract yesterday, this has affected profit margins. The seller makes their supply via eBay. eBay have taken control of the supply VAT and have accounted for the correct VAT within the EU. However, it's the profit margin that has been affected by this, because the price quoted on eBay is inclusive of VAT. And so eBay will deal with the VAT, deduct their charges, and then the net amount is paid back across to the UK seller. So having the correct pricing structure is really important. But obviously there are benefits of IOSS. And the benefits are that they allow for the collection, declaration and payment of VAT for the sellers on one VAT return, rather than having to register in each member state where sales are made to. The buyer is only charged at the time of purchase and doesn't have these nasty surprise fees when the goods are delivered. So if the seller is not registered, the buyer would have to pay the VAT and customs clearance fee charged by the transporter. This VAT payment is only applicable to purchases made by a buyer within the EU and for goods valued at less than €150. For goods which have an intrinsic value more than 150, this IOS does not apply. Sellers registered in the IOSS need to apply VAT when selling goods destined for the buyer in the EU member state. And the VAT rate is the one applicable in the EU member state where the goods are delivered. If businesses are not based in the EU, they will need to appoint an EU established intermediary to fulfill all of these VAT obligations under the IOSS. So those are the main points about this new system. And again, leading up to the introduction of this new IOS scheme, we did have many queries about it. So hopefully this is just an overview of why it's there and how it can benefit your business. But I'm going to pass over to David, who has a wealth of experience in assisting businesses throughout all of these changes and has been doing so for the last few years leading up to Brexit. So David, thank you for joining us, and over to you.
Thanks, Annette. Yes, good morning, everyone. Nice to be with you this morning. As Annette says, Brexit has occupied my sort of working life really for the last 2.5, 3 years. Certainly the last 6 months of 2020, building up to planning for how to deal with imports and exports of goods to and from the EU. Once we did leave the Customs Union on the 31st of December last year. And this year, certainly the first 7 months of this year have been rather interesting, should we say, in terms of dealing with the fallout of not just the how-to part, but also the terms of reference of the EU-UK trade deal that was held out to be an oven-ready trade deal, but has proved to be anything but. So what I'm going to cover this morning is a run through main considerations in terms of what we need to consider when we're actually importing from the EU or if we're exporting to the EU, practical tips on the kinds of things we should have thought process wise. And then after that, have a look at some strategies, or as part of that, look at some strategies in terms of what we should consider to mitigate any potential losses. I'll do I'll go through the trade deal terms of reference as well. One of the misnomers is very much, okay, because we have a trade deal, everything that comes from the EU is not subject to duty, or anything that goes to the EU from the UK is not subject to duty. That's not actually the case. There are some real anomalies that are worth considering. So I have got some slides which hopefully you can all see. It's not death by PowerPoint. They're trigger points really just to focus the points we're discussing. So you'll find hopefully they're not too text heavy. So I've kind of already covered those bits. So from a practical point of view, irrespective of the duty position, so this applies irrespective of whether duty is payable, irrespective of the trade deal that's in place. Any movement of goods into the UK, I'm not really going to go into Northern Ireland in any great depth. It is very much an anomaly. I'll cover that, the anomalies later. But any movement of goods into the UK from anywhere in the world, so now including the EU, requires customs formalities, and there are some differences between imports currently and exports. So the first thing we need to do is, when we're buying from the EU, it's very simple. Before we left the customs union, you didn't have any customs paperwork to think about. The last time we had that was in 1992, before the single market, or when the single market came in. So we now have to consider what customs paperwork do we need. Because if you don't consider it, one of the big things that I find dealing with the businesses across the UK is that quite often it's not the duty position that causes things to fall down. It's actually people not having the right paperwork and not understanding what they need to provide to whoever is doing the transport and clearance, not understanding or not providing the right paperwork, so goods get stuck in customs. And that's what we're trying to avoid. So the first thing, if we consider imports first, the first thing I would always suggest is understand your supply chain. Prior to the 1st of January, sort of the supply chain was very much saying to the suppliers, okay, effectively who's going to do what from a delivery point of view. And it would either be a UK business would go and collect, send their transport and go and collect, and bring the goods across the border with no customs paperwork, or that the supplier would deliver. What we now have is we have a border, a hard border with Europe, in that in order to cross that border, somebody needs to be responsible for customs paperwork. Bearing in mind that as well as there being an import declaration required in the UK, and I'll come on to the different kinds in a second, as well as a UK import declaration being required, there's also an EU export declaration required. There are no easements, so whoever is actually the exporter of record coming out of the EU will need to make sure there's an export declaration for those goods to ship through. So one of the first things is understanding and then agreeing with your supplier what trade terms you're going to operate on. Typically, the term DDP was bandied around prior to Brexit. That was something that was like, well, okay, you'll supply me DDP, which means that the supplier would deliver to your premises. DDP as a term was a slight misnomer, so deliver duty paid. So they would deliver to your premises duty paid. So it was a bit of a misnomer before the 1st of January 2021, because of course a EU supplier supplying a UK company DDP, there was no duty to consider, because trade between the UK and the EU didn't factor in duty. There was no duties payable. We were part of the customs union. The fact now is that delivered duty paid does mean something slightly different. So when you're talking to your supplier, agreeing the incoterm, agreeing the terms of who's going to supply to where, and understanding that is very important, because if you say to your supplier, please deliver DDP, the chances are things will get held up in port, because what that actually confers on your supplier is that they will become importer of record in the UK. Now, aside from a few specific instances, I know some of the big retailers are saying to EU suppliers, if you want to supply to us in the UK, you will become the importer of record and you will supply DDP, which has caused some EU suppliers, and we have a number of businesses in the EU where we have VAT registered them, and we've got UK URI numbers, so they are the importer of record. Aside from those specific instances, most EU suppliers are not going to want to supply DDP because they won't want to get involved with compliance for importing into the UK. They'll really be looking at UK business to do that, which makes sense. But it's understanding and agreeing with your supplier what terms you're going to trade on. There's no reason not to do this. There's no reason to try and hide this, and from no other reason than to make things run smoothly. It's good to have that agreement in place as to who's going to do what and who's going to be the importer of record. Similarly, an ex works term, if you buy ex works, so actually you are responsible for collecting goods from your supplier in Europe. It's understanding what the obligations are in terms of making sure export paperwork is submitted, because that will fall within the UK business remit to submit that paperwork. However, you would want your supplier to be the exporter of record for two reasons. Number one, it means that they then will zero rate their sale from a VAT perspective, because they are exporting from the EU. And number two, because on a practical level, UK businesses are not allowed to export from the EU directly. They would have, if a UK business wishes to export from Europe, from the EU, they would have to use an agent or a representative to stand in their shoes to do that. They cannot be shown as exporter of record as a UK business. Unfortunately, one of the outcomes of us leaving the EU is we are now UK businesses are non-EU established, so the benefits of the customs union are largely gone. And that's the consequence of deciding to leave the EU. Whether it was good, bad, or indifferent, I won't go into. I'm sure we've all got our own opinions, but that's unfortunately a matter of fact, that we cannot enjoy the same benefits that EU businesses do. So UK businesses are largely treated like any other third country business, in that we cannot export from the EU. So understanding who's going to do what is always a good starting point, because that then leads on to, well, if the UK business is a UK importer of record, which does largely make sense, we have obligations. Now, we at the moment, and until the 31st of December 2020, a UK business that is importing into the EU has an option on when it lodges an import declaration. One option is to use a system called delayed declarations. So in essence, and this is the government brought this in initially till the end of June, but they've extended it now to the end of December. And what they've basically said is, rather than hold up traffic physically, particularly through the roll-on, roll-off ports, rather than hold traffic up because people may not have the right paperwork, you can opt to not do any kind of declaration point of import. You can just have your EORI number to hand, EORI number, which in order to import and export you need. If you haven't got an EORI number, it's very easy to apply for, but you won't be able to import or export without that EORI number. And it should match the company details, and effectively it's your VAT number with 3 zeros on the end, unless you're in a VAT group, and then you would have 3 different final digits if you're in a VAT group, because every company of VAT group needs its own EORI number. But all you need to do is quote your EORI number and then record the details under, it's actually called EIDR, Entry in Declarant's Records, when your consignment arrives. Record the details in your records, so that would include commodity code, it would include value, it would include weights and dims, it would include all the commercial details you would have regarding that import. And then within 175 days of import, you need to lodge a thing called a supplementary declaration. Now, a freight forwarder or a clearance agent can do that declaration for you. And I would always recommend that you use an agent rather than try and do it yourself. Doing it yourself is quite a convoluted process, and it involves having to buy software and have links into the HMRC system where clearance agents are geared up for that. You have to, within 175 days, lodge a supplementary declaration, bring into account any duty. VAT is, you have to use postponed VAT accounting if you're lodging a supplementary declaration to support a delayed declaration, but you have to do that within 175 days, otherwise it's non-compliance. So we're now into August, we're now into anything that came in January and February, or the early part of February, should now have had supplementary declarations lodged, and if not, you need to fairly quickly. The VAT just would then actually go onto your postponed VAT accounting statement. In looking at that, the way of actually accessing that is you have to register for a system called CDS, and that populates, once you've got a CDS account, that takes about 10 minutes to get. Once you've populated, got your CDS account, HMRC will put your postponed VAT accounting statements into that account, and you can find out how much VAT you need to declare on your VAT return. Now, the slight disconnect between delayed declarations is, whilst you have 175 days to actually lodge the supplementary declaration, in other words, make the customs declaration, the VAT that's due on your import is actually due in the VAT period in which the import took place. So if you have say a March quarter end VAT period, but don't actually submit your delayed declaration, say till June, then actually the VAT is due to be submitted on your March VAT return, even though you've not lodged a delayed declaration until June. So the VAT won't appear on a postponed VAT accounting statement because there's not been any declaration lodged. So as all good finance people would know and love, HMRC ask for people to estimate the VAT, the import VAT that's due, which we all love a good estimation on the VAT return, don't we? So it does cause some practical considerations and practicalities around, if you want to use delayed declarations, managing when those declarations are made. So it's got its value to get goods through quickly, but there is some administration to consider. And just going back on postponed VAT accounting, the actual method of actually VAT appearing on a VAT account, postponed VAT accounting statement is, you have to actually notify your clearance agent that that is what you want to do. So if they're lodging a supplementary declaration on your behalf, you need to say to them, well, make sure, of course, this is going on to postponed VAT accounting. If you don't tell them that, you'll end up incurring VAT and then claiming it back via the old method of the C79. However, one of the conditions of delayed declarations is you must use postponed VAT accounting. So it's that connection and that communication with your agent. So this applies irrespective of whether there's any duty payable. You still need to do a declaration to tell HMRC that no duty is payable. And I'll come on to how we actually make sure duty isn't payable shortly. The alternative is to pre-lodge or to raise what we call a full entry before the goods arrive. And that can be done either through what they call a standard declaration or through a simplified system called CFSP. But either way, a declaration is made at the point of entry. This system is actually coming in from the 1st of January 2022 for all imports, so delayed declarations will go. So I always say to business, you make an informed decision. Many businesses say, well, you know what, let's just get the reporting out of the way when goods arrive, and let's actually make sure that we do full entries. It's done then. The postponed VAT can go onto the postponed VAT accounting statement, and any duty payable is paid at that point or not, depending on whether the duty is payable or not. It makes sense to do that because the declaration is made and you haven't then got to think about, well, when are we making supplementary declarations, etc., etc. So full entries are, I think, has got merit. In terms of full entries, I'll come on to some of the details we need shortly. In terms of exports, there's a slightly different message in that the actual paperwork for exports started on the 1st of January 2021, in that in order to get goods exported to the EU or elsewhere, an export declaration had to be lodged prior to goods effectively arriving at the port. And again, that's to stop lots of sort of traffic backing up at the port. So what should be happening if you're exporting to Europe is that whoever you're shipping with will ask you for the details of the shipment prior to collection. So that will include what the goods are, commodity codes, I'll come back to commodity codes in a minute, commercial invoice with values, incoterms, and weights and dimensions. If you don't provide that information, the likelihood is they won't collect, because they will likely get fined if they turn up at the ports without the correct documentation, because they'll just be clagging up from a traffic point of view. So there is that information to give, and making sure that they give you that, or you give them the details for a declaration. They should then give you a copy of the declaration once it's lodged and cleared, because you'll need that from an evidential point of view for VAT 0 rating. In terms of understanding your supply chain, there's a strong message to think about there. And again, consider incoterms with your customers. I've done a lot of work in 2021 and in 2020 leading up to that in terms of businesses, whether a UK business supplies DDP into Europe or DAP. DDP, as I mentioned earlier, is delivered duty paid. So effectively, if you agree DDP terms with a European customer, it means that you're not just responsible for the export declaration from the UK, but you're also responsible for being the importer of record in the EU. And that opens up quite an involved conversation, shall we say, and I'll just briefly touch on that in a minute. Whereas if you arrange DAP, which is deliver at places, you can still deliver to your customer and arrange the shipment and the paperwork, but your customer is shown as the importer of record. And it's very important we establish this, because the meaning of both of those and the consequences is quite wide-ranging. And again, in terms of one of the big headaches, well, there's two big headaches, I think, with exporting to the EU from a practical point of view. One is, okay, things being stopped at customs in country, in a country of wherever the goods are going to, but a country of destination. And also from a financial perspective, DDP, as I mentioned, means that you as the exporting business are responsible and the importer of record in Europe. So that means that the customs clearance will be done in your name. There'll be EU duty applicable if EU duty is payable, and import VAT will also be payable. So it's whether you need an EU VAT registration. And one of the planning points that we get very much involved with, and you might ask the question, why would we ever supply DDP, David? Well, I'm finding there's probably two situations. One is where customers are pushing back and saying, well, we don't want to buy, when we're not used to importing into the EU from the UK, we don't want to get involved in the import process. If you want to supply us, then you're going to have to supply DDP, because we just don't want to get involved. So it might be from a commercial perspective to service the EU market. As a UK business, it's a case of, well, we need to take the bull by the horns and supply DDP. So generally it's customer pushback, either directly where customers are saying, we will not buy from you unless it's DDP, or where customers are kind of bulking and kind of not actually saying, we won't deal with you, but are sort of saying, well, life's a bit more difficult and we want to make life easier for customers. So typically there are a number of things to consider there. Where do we ship through? If you let's take a bonkers scenario, but say we supply to all 27 member states, well, patently you wouldn't want to have to do customs clearances in 27 EU countries, final destination countries, because you're dealing with 27 different customs authorities. Although the rules are the same from a legislative perspective and from a duty point of view, local differences do apply in terms of how easy countries are to deal with. So you wouldn't want to do 27 have to deal with 27 customs authorities. You'd also lead on to probably needing 27 VAT registrations. So what we typically do is from a planning point is say, well, okay, where do you ship to? And rather than customs clearing in final destination, look at practicalities of maybe customs clearing at the first point of entry, be that the Netherlands, Belgium or France, there's some very good easements, which means that you can actually customs clearing somewhere like the Netherlands. You don't even have to be VAT registered there. There is a way around it, but you can be VAT registered there, and VAT would wash through. They have a situation where if you supply a DDP, yes, you pay the duty, but they have an equivalent to postponed VAT accounting in the Netherlands. And of course, if you're customs clearing in the Netherlands, any intra-EU supply, then any movements to other EU countries will be an intra-EU supply if you're supplying business to business. So from a cash flow perspective, it all washes through. So what I would say is, again, without going into huge detail, is understand from an export point of view, understand your supply chain, who's going to do what. If it's a case of, okay, it's supplied, we supply, we export from the UK, customer imports into Europe, make sure they understand they've got to do that, because you know, the import process will fall on them, but make sure that, you know, you're giving the right information to your clearance agents so that things don't get held up either on outbound from the UK or inbound into Europe, and then consider the incoterms with your customers, because there's some very clear messages to take if you do supply DDP, but it's just actually looking at the planning around that. And just talking again on information to put onto declarations, be it import or export. Really, there's only three things HMRC will ever seriously be interested in when they're doing an audit. The first thing is commodity codes. Hopefully you're familiar with commodity codes, but every product that is imported into the UK or exported from the UK requires a commodity code. It's 10 digits for imports and 8 digits for exports. At import, the importance of the commodity codes being set correctly is that it determines the amount of duty payable, the standard rate of duty. So I'll come on to the trade deal in a minute, but absent any trade deal, it shows what duty percentage. Normally it's a percentage of the customs value. Certain products, particularly foodstuffs, it could be a monetary value, so many euros per kilo, but usually it's a percentage of the customs value. So it's important that you understand, or you set commodity codes and understand how to set them. There's a process for doing that. I think time will prevent me going too much into that this morning, but commodity codes are important to understand and set, and be comfortable, even if your clearance agent sets them, be comfortable that what they're declaring is correct. The trade tariff can be found on the gov.uk website. The value, the customs value, also is important because it determines the amount of duty that might be payable and the amount of VAT that might be payable, and that's based on the cost of the goods. So if you're doing a supply, if you're purchasing from a supplier, it's what you pay your supplier, which is the customs value. So you have to consider things like royalties because they're dutiable. So if anything, you pay to your supplier for buying those goods. Now, if there is no purchase because you're transferring goods where there is no purchase from your customer. I do a lot of work with universities, British universities, who are always moving goods around with collaborations in other countries where there is no purchase. So there are alternative methods of valuation that need to be considered if there is no purchase. 95% of imports, there is a purchase, but if there's not, you have to look at alternative rules, which is basically what would the value be if you bought that from a third-party supplier. Now, if there is, again, there's no purchase, we have to look at things like what is the cost of the goods to produce. So understanding the customs value is based on the cost of the goods that you're buying, plus any insurance and freight that you pay to get those goods to the UK. So again, depending on your Incoterms, who's actually delivering to where will actually affect the build-up of the customs value. So if you're buying Ex Works, for example, your clearance agent should be adding on the freight charges they're charging you to transport those goods from Europe to the first point of entry in the UK in order to build up the customs value. So those pieces of information are very important, and clearance agents will ask you for an instruction regarding those. And then the third element is if there's any duty reliefs, any special schemes we're looking to use, and I'll come on to some of those in a minute. Giving clear instruction to your clearance agent that what you want to do happens. It's all about giving clear instruction to the clearance agent. They may not always follow it, but tell them it's your responsibility as an importer or exporter. The declaration is your declaration, not their declaration. So it's being proactive and giving them that information, so at least we've got a chance of it being declared correctly. In terms of the trade deal, the duty-free trade, so the misnomer we do have is because we have a trade deal with the EU, we've agreed a trade deal with the EU, it means necessarily that everything that is imported into the UK from Europe is duty-free, and anything that goes from the UK to Europe on export is duty-free. Unfortunately, that isn't the case. The trade deal that we ended up is far from the trade deal that I think Boris held out would be the case. And quite frankly, it's a rather rubbish deal, and it's unnecessarily complicated. And I'll try and debunk some of the myths around it. But in essence, the way that the tariff works, the way that the duty works, is everything will be subject to the full third rate of duty against a commodity code, unless one of two things applies. Either the duty rate for the commodity code is 0%. So some products, for example, I was looking with one of the universities last week, they import some medical equipment, and the commodity code for that medical equipment is such that the duty rate, the third party duty rate, is 0%. So the import of that particular piece of equipment from anywhere in the world is 0%. So actually we don't need to worry about trade deals or anything like that because it's already 0%. However, if there's a positive rate of duty, so if we take something like garments, importing garments from anywhere in the world, including Europe, the full rate of duty is 12%. Now, what the trade deals mean is actually, if those garments are deemed to originate in the country you're buying from, so in this case, let's look at the EU trade deal, because the UK does have trade deals with lots of other countries as well as the EU. But if we concentrate on the EU trade deal, what we're looking at is, okay, if those garments are deemed to be of EU origin for preferential duty purposes, then if we actually get a thing called a statement on origin, we can actually then say, well, as long as we're happy that those goods are manufactured in the EU, then we can get them at zero duty. But there's a two-stage process. The first thing, and this applies equally for goods that are being sent to Europe, and there is quite a strong message I'll give in a minute on issuing statements on origin to EU customers. The first thing is there has to be a process. So all free trade agreements or trade deals are actually based on there being some kind of manufacturing or some kind of processing. So for a UK supplier to supply to customers in the EU and say, okay, these goods of UK origin, the first thing there has to be is a process. If there is no process, so one of the typical situations that I've come across is businesses that import goods, finished goods from, say, the Far East, bring those goods to the UK because the UK is the distribution point for the UK and Europe, and then send those goods back to Europe. Those goods will never qualify as being of UK origin because they're finished goods. There's no processing taking place in the UK. And even if you're repackaged or something like that, there is a minimum level of processing that has to take place for UK origin to be conveyed on those goods. So if you're bringing in garments from anywhere outside the EU or even the EU, and they are not being processed and they go back to the EU, then we're looking at potential double duty. Okay, and I'll come on to mitigation on that in a minute. So the first thing is, are the goods subject to a process? And if they are subject to a process, what we then look at is, well, okay, what are those goods made of? Because if those goods are made of components or ingredients or materials which do not originate in the UK or the EU, then there are rules of origin that actually say, well, for those goods to be of UK origin, we need the proportion of non-UK EU material in that manufacturing process cannot exceed a certain level. So there are some quite complex rules, and those rules are based on what the commodity code is, what they are, and they're typically the two typical ones are that either the non-originating material has to be a different heading to the final goods, or that they can't be more than a certain value of the final ex works price. They are dependent on commodity code. But I think the point on this, without going too technical, the point on this is the government have made it very easy for UK businesses to fail, in that the only requirement for a UK business to put the only requirement is statement on origin wise. So in other words, if you're supplying an EU customer who say, well, can you put your statement of origin text on saying these goods are of UK origin? The only requirement as a UK business you need is to quote your EORI number, is to quote the text with your EORI number. So you don't need any prior approval to do this. So it's very, very easy to do. However, in signing that or in giving that statement, it's understanding what the rules are. Because if you give a statement that's false, and I'll give an example. I work with a business that manufactures in the UK hairbrushes, but they, as well as in their product line, they import combs from a Swiss supplier. Now, Switzerland's not part of the EU. They bring the combs in as finished combs, and all they do is stamp their logo on the combs, which isn't sufficient to change the origin from Switzerland to the UK. Yeah, when I was talking to them, they were saying, well, we give the statement on origin saying these goods are of UK origin. And what I've said to them is we can't do that because A, it's false. They're not of UK origin because you're not doing enough to make them of UK origin. B, it means that you're actually giving your customers effectively a document where they'll claim duty relief where they shouldn't do. So aside from being non-compliant and HMRC coming along at some point and saying, well, actually, you're not meeting your regulatory provisions, you could have a very upset customer who suddenly gets landed with a big duty bill. So you need to consider it and get it right. But it's very easy to issue it when a customer asks, but you do need to have the backing to be able to say, because HMRC will come and audit this. There is provision in the deal for both UK customs and overseas customs authorities to sort of mark the homework of the supplier, the exporter supplier, to make sure that the rules of origin are met, because that document will be relied on by your customer, or you will be relying on it from your supplier to claim the preferential rate of duty. So if we go back to our friend garments, if we're claiming duty at a reduced duty of 0% instead of paying 12% duty on the basis of a statement on origin and it's wrong, we could end up with a 12% duty bill. And that's the same effect of issuing a statement on origin incorrectly, is that you could be lining your supplier up for a fall. So what I would say is don't not do it. Don't not issue statements on origin if a customer asks, but do your homework and make sure you understand in either claiming preference in import or giving a preference document at export what the actual rules are, because either way there are regulatory provisions. I think I've really covered this slide. In terms of actual import, the documentation needed is statement on origin, or if you actually, and again, if you're supplying, say, DDP into Europe and the goods are of the UK origin, rather than having a statement on origin, you can claim what is called importer's knowledge. So you can actually claim preference without holding any official documentation from your supplier, but you need to hold evidence as why the rules of origin are met. So I've got one client who, what they actually do is they hold a bill of materials for wetsuits. They have wetsuits manufactured in Romania. They hold a bill of materials to show how that wetsuit is manufactured. They actually qualify as being of EU origin because they go to Romania to be manufactured. And when they come back, I've said to them, look, claim preference on the basis of importer's knowledge because you already hold the information because you hold the bill of materials. So that they work like that. So some of the anomalies under the trade deal, I've already mentioned finished goods that are imported from for example, the Far East. It could be anywhere in the world. There is possible double duty. So one client of mine, they import swimwear and sort of anything to do with sort of swimming, so beach balls and rubber rings and things like that. They have a distribution centre up in the northeast. They bring all their products in from China. It's all finished goods. They distribute from their premises up in the Far East. They don't have the capability of splitting their supply chain to ship direct into Europe, because the shipments into Europe are as they get orders. So everything comes to their warehouse in the UK. 35% of their sales out to Europe. So there is a possibility of double duty in that they would have to pay duty coming into the UK, and then on export, there's duty on import into Europe, because the trade deal doesn't cover the situation where goods come to the UK first. So what we've done there, one of the strategies that we've explored is they've actually set up their own bonded warehouse. So they bring goods in, about 40%, they tend to put 40% of what comes in into their bonded warehouse. So when those goods are then re-exported to Europe, yes, there is duty going into Europe, but there's no UK duty. So it's reducing that duty liability. And again, I think the duty rate, the average duty rate across their product line is about 10%. So they've worked it out. It will save them in excess of £100,000 worth of duty unnecessarily, but by setting this up. Now, we could sit here and say, should we have to do that? Is that what the trade deal envisaged? Of course it's not. It's not what it was envisaged, and I don't think anybody would say it's an ideal situation. I use the term, it's the least worst option. It's a pain because there's more administration around it, but it's considering that kind of strategy in looking at can we mitigate their duty. There are other duty release available. Another one, so customs warehousing is for storage. If you're bringing in goods which you're processing and then re-exporting, there's another relief called inward processing, which again suspends duty and VAT while the goods are in the UK being processed. So it means there are sort of thought processes to go around regarding importing. A very common one, which has become more prevalent since Brexit, is okay, we're exporting goods, UK goods, to Europe, and those same goods come back. So it might be we're sending goods and our supplier, our customer decides they don't want them, so they return them. Well, we don't really want to pay duty and VAT on UK goods being returned from Europe. We can't claim preference because those goods are UK goods, they're not EU goods. The supplier, the customer who's returning can't say these are EU goods being returned. They're actually UK goods being returned. So there's a relief called return goods relief, which means that if you've got goods being returned from the EU unaltered, you can claim duty and VAT relief as long as you can link up your import to where the goods were originally exported. Whether that was prior to Brexit or not, that there's actually looking at, should be able to show that these goods were in the UK originally. Earlier in the year, you may have heard about Percy Pig, which is an M&S confectionery product. Percy Pig is manufactured by M&S in Germany, and they bring in their sweets, the sweets into the UK for distribution to the UK and Ireland, Republic of Ireland, and it was sort of headline news. But they're using return goods relief when the goods go back into Ireland, because they lose their EU status when they left the EU. As with UK goods leaving the UK, they lose their UK status when they leave the UK. So return goods relief is a good one if you've got goods coming back which you've exported for any reason, but they're coming back unaltered. Similarly, if you've got goods that are going out of the UK for some kind of processing, there is a relief called outward processing relief. So it's similar to return goods relief, but it's for goods that are being sent out for repair or any kind of process. So if you send goods to the EU, of course, it was never an issue before. You could send things out and they'd be worked on and come back, and none of these considerations. But that is a relief. If you don't look at these things, you will end up with a duty bill, you'll end up with a duty bill, because the way that it's written is everything will be dutiable unless you actively take steps to say to your clearance agent, well, either we're claiming preference or we're claiming a relief. So if you've got a situation with goods moving around like that, it's just worth bearing in mind. An unfortunate side effect of the trade deal is, one client of mine, he imports blank T-shirts or white T-shirts, clear, white T-shirts from Pakistan. There is actually a UK trade deal with Pakistan under a thing called the GSP arrangements. So he brings his T-shirts in zero duty coming into the UK. He then processes them in the UK, he then puts screen prints on them and sends them to Europe. Unfortunately, when they go to Europe, they're subject to 12% duty. Because although the EU has a trade deal with Pakistan, it's a different trade deal to the trade deal that UK's got. And because he's actually doing a process in the UK, the EU GSP trade deal can't wash through. So there are very strange situations where if you bring goods to the UK first for some kind of processing, and then they go to the EU, duty is paid somewhere where it wasn't before. So I think what I would say is it is worth mapping out if you're moving goods around and goods coming back. It's worth mapping out to look at how best to avoid these duty and VAT charges. So really, conclusions are: be proactive. Many businesses see Brexit as a UK problem, and I say quite a lot of businesses I deal with sort of have taken that on and said, well, okay, as it's seen as a UK problem, whether it is just a UK problem, well, it is, because we're the ones that left. But they see it as a UK problem. So really, it's a case of being proactive in dealings with EU suppliers and customers, and I say, and understand the rules, because the government have tried to be helpful in terms of things like making it very easy to issue preference documents for export, but understand what that means, because the rules are complicated, unfortunately, and I can't help thinking they're setting people up for a fall. So last couple of slides are just who I am and where I live. But that's kind of a quick sort of run through. One very quick thing I'd say is they are phasing some additional sort of changes to the Brexit rules coming in. So as well as delayed declarations, there are, if anybody imports foodstuffs or plants or anything like that, there are rules coming on the 1st of October in terms of health certificates and licenses. So be aware of those. And then additional rules again on the 1st of January in terms of inspection. So that's a quick fly past of some of the practicalities and some of the common things that I'm finding are cropping up and we're dealing with. I think I've done more work on origin and looking at sort of rules of origin in the last 7 months than I've probably done in the 30 years that I've been dealing with customs. So it has changed the landscape a lot. So hopefully that's been of some use. And if we've got questions, I think we've got some questions, but I don't know how you want to answer those. But that's me for the moment.
Okay. Yeah. Thanks, David. If you want to stop sharing your screen, that'll be fine. Okay. Yeah, we've had a few questions. I know we've got a couple of minutes left, so if I just sort of canter through them. We've had one from Marie, and she's saying, is there a similar scheme? Annette mentioned the iOS scheme. Is there a similar scheme for supplies to EU which are greater than 150 euros?
No, there's not. It's. I mean, we've now got the unfortunate, for me, everybody else's benefit. We've now got the unfortunate situation where, I mean, iOSS has effectively replaced what was distance selling. So, if you cast your mind back to the halcyon days of us not having left the EU, if we made B2C sales to European consumers, we used to have to do distance selling, so have potentially multiple VAT registrations, and that was for sales of any values. We now have the situation where iOSS has kind of replaced distance selling in Europe. So we've got iOSS for less than 150 euros. We've got, and then above 150 euros, because there's duty as well as VAT to consider, there is the rules that applied before iOSS came in. So we've kind of got two B2C rules and one B2B. So it's, unfortunately, as with everything with Brexit, it's by no means clear. Well, I say by no means clear, it's a bit more complicated. So it's looking at what's the least worst option, unfortunately. But no, okay, there isn't an equivalent iOSS for over 150 euros. Okay.
We had a question on registration from Len Eden. Why do we have to pay VAT on the import of used yachts that are VAT paid in the EU?
The simple answer is, unfortunately, because we've left the EU, we're now a third country. So any movement of goods from the UK, from the EU to the UK, will be subject to duty and VAT. The only real exception is anything that was previously in the UK, which at the date of Brexit on the 31st, 11 o'clock and 31st December, anything that was previously in the UK but happened to be in the EU on that date, when it comes back to the UK, we can bring it in duty and VAT free under return goods relief. and there's a window till 30th of June 2022 to do that. But if we've got a yacht that's never come to the UK previously, when it comes to the UK, unfortunately now, because we're no longer part of the EU, there will be UK duty and VAT to pay.
Yeah, okay. Interesting question from Chris Kemp here. He says, I've been told by customs that carrying an expensive laptop for working in France for a few days will require a simple declaration form and another when it comes back into the country a couple of days later. So he's been traveling for work in France will often make this trip more onerous. And there seems to be a possibility of paying duty and VAT again if the paperwork does not fit. What's your view on that scenario?
I think you're right. You're right, Chris. I think what we do have is provisions for return goods relief, because if you're taking out equipment which is for work and it's coming back, there's return goods relief. There is a procedure for taking goods out if you're taking it sort of hand luggage, called merchandising baggage. And that basically says, well, if you're a business or you're somebody who's working for a business and you're taking business assets out of the country, you can actually do that rather than doing a full customs declaration. You can actually do that using merchandising baggage documentation. You have to present that documentation at customs at export and again at re-imports. So again, there'll be merchandising baggage, and you can claim return goods relief by doing that. So if you don't do that, yes, duty and VAT would become payable if customs find out about it. But if you are proactive and actually operate the return goods relief process, and if you're taking it merchandising baggage, you'll have your stamped merchandising baggage paperwork on the way out that you can present along with the paperwork on the way back in, saying, well, that's where I took it out. I took it out as hand luggage. So, but if you don't take that proactive step, there will be duty and VAT technically liable.
Yeah, so never more important to get your documentation ducks in a row there, isn't it?
It is, Patrick, and that's where again, talking to a lot of organisations, it's as much getting the paperwork right, even if there is no duty and VAT actually payable. It's getting it right, because otherwise, what a lot of the couriers in particular will do is just block things. They'll say, well, until the paperwork is right, you can't have your goods, and that does create commercial issues outside of the financial issues from a customs, a duty and VAT perspective. It does create commercial issues because, if goods are blocked and they're sitting in customs, you've got demurrage charges and you've got just a hassle of dealing with it. So get the paperwork right, first up, it helps things.
Okay, and then we've had a few questions from James Dixon. Thanks for those, James. I'll just counter through them. I think you may have answered this already, but he's saying we have an EU supplier who's been shipping goods to us under the DDP. From what I understand, they are responsible for paying the VAT and duty under these terms, but are we required to make customs declarations on these imports, either on our 2021 supplementary declarations or import declarations after January the 1st, 2022?
Well, the simple answer is if they are, I'm going to say truly DDP, but if the arrangements are with the supplier that the supplier will actually be the importer of record, then no, you have no obligation to lodge those customs declarations. The reason I say if they're truly DDP, this is where it's talking to the supplier and making sure they understand that they are the ones that are actually going to be the importer of record and responsible for doing the customs declarations. Because again, from experience this year, a lot of because of the pre 1st of January DDP interpretation, a lot of EU suppliers kind of say, oh yeah, well, we get DDP, and then when they turn up at the port and are asked to lodge a customs declaration, say, well, we're not doing that. And in effect, what they really want is to supply DAP. So the answer to the question is, if it is truly DDP, no, you don't have any responsibility for customs declarations, but it's just worth being very clear with the supplier that they get that it's then down to them. Framing it in a way that if you want them to do it, they kind of say yes, but we don't want. I did have one client who was very green to importing. This is pre-Brexit, very green to importing. He said, well, we buy DDP from our supplier. It said that in the contract. Anyway, customs approached them and said, oh, we've got 66 imports you've done this year. It's a pardon. Anyway, the DDP, what the supplier was doing was saying, yes, we'll supply DDP, meaning we'll pay any duties. But they were instructing the clearance agents to use my client's details, so it wasn't DDP at all. And to boot, when we looked at the customs declarations that had been lodged, they'd been declaring a commodity code which had zero duty, which was wrong, and the liability was actually 4%. And it was my client that was in line for that 4% duty charge because they were the importer of record. So I know I'm labouring the point a little bit, but it is worth just making sure that if what you've explained, yes, that there is no responsibility for yourself, just making sure that your supplier does fully understand that and does fully get that, because what we don't want is customers turning around and say, well, actually, we're going to come to you because of UK business. So
Okay.
I know it was a long answer to a short question, but that makes some sense.
Okay, probably possibly a rather shorter answer then. Again, yeah. He's looking at digital trader services, which is a assisted online service provided by Fujitsu for making his customs declarations. Yeah. He says, as I understand it, this provides an interface to Chief. Have you any views on this?
Yeah, yes, it does. It'll interface into Chief, and then next year, the Chief will be replaced by, I think, called CDS. So it should interface into CDS as well. I mean, what I would say is, by all means, do your own customs declarations and use a service like that. The only thing I would say is it's worth weighing up, depending on the level of import or export declarations you're doing. It's worth weighing up the cost of you doing it yourself, both from a platform service payment perspective, what they charge you, plus the time it takes you and your staff to actually do those declarations versus using a clearance agent. I'm not saying the DTS route is a bad way to go. I always like people to make an informed decision. I find doing your own declarations is something that you need to be across everything that's going in, where quite often there's a lot of data that from a financial perspective we don't really give a stuff about, but has to go on the declaration, and a lot of that is data gathering for HMRC's purposes. So it's understanding things like supplementary units and what needs to go on. So again, a slightly longer answer than maybe we anticipated. They're fine, but it's always worth just talking through doing a comparison on cost, and clearance agents are geared up for doing everything. So yeah, I'm not saying don't use DTS, but just look at the hidden indirect costs of things like how long it would take you to do, as well as the direct platform costs.
Okay, I'm conscious of time, but just a couple more questions. As you know, these guys have taken the, they've actually taken the trouble to ask them again from.
Absolutely, yeah.
He's saying we import children's clothes from the EU, brackets, they're made in the Far East, that are zero rated for VAT in the UK, obviously. Will these be zero rated for import VAT?
They will. The reason being is that import VAT is charged at the same rate as the UK domestic rate. So if it's zero rated children's clothing in the UK, it's zero rated at import. So that is a very short one.
And then the final question I'll deal with from Simon Bennett. He's saying, hi, we hold stock for EU clients that were invoiced to them pre-31st of December 20. We then just send the goods to them as and when they need them and charge them carriage charges. I appreciate we'll pay the duty if we do DDP, but how is the VAT calculated on these goods that have already been invoiced and paid?
You would actually pay them on what you've invoiced them for, because that would be the customs value. So the transaction has actually already taken place because they've paid you. They've paid you for those goods already. And it kind of spins on to another question. Well, what if you supply them DDP? Well, there is no transaction between you as the exporter and you as the importer. Therefore, what value should you use? And again, it would come back to the second method we look at is what would the value be of identical goods if you sold them at the same time to the EU? So it will be on your sales invoice, even though you invoiced them prior to the 1st of January.
Okay, well, that's great. Thank you very much, David, and appreciate you talking so much. And so thanks for that. I would like to wrap things up at this point. Obviously it's quite a complex sort of topic. So if you do have any more questions, please do submit them at the events@thomaswestcott.co.uk address. And, we'll forward them to either Annette or to David, and they can sort of get back to you directly on those. We would attend to every question that we get. Finally, then, it just remains for me to say thank you to Annette and especially David for coming along today. Thank you to, actually, she's not Amy Gilmore, it's Alex Eastland from our marketing team who's actually done the behind the scenes stuff. I would say actually that Alex has been recording the webinar and it will go on our website. So if you want to kind of browse through especially David's sort of talk to us, then you can at your leisure. And you'll be sent also, Alex will be sending you a copy of that recording to all our attendees today. So actually, yeah, you won't have to necessarily go on our website. So thank you, Annette. Thank you, David. Thank you all to our lovely attendees, and have a great rest of the week and stay safe. Cheers for now.
Thank you.